can't control what the future holds, but you can take control of your investments with principle. Whether your goal is to enjoy a comfortable retirement or to secure your financial legacy for future generations. After all, your future and aspirations are worth investing in. That's why we offer a wide range of fund options that gives you global and local exposure for better returns. With more than 142 years of global investment experience at your fingertips, you can take full advantage of opportunities to build your wealth. And we make it easier for you to manage your investments with our enhanced digital solutions. Now you can easily buy, redeem and switch your investments at your own convenience with our easy-to-use online investment portal. Never miss the right opportunities to invest with cash or iInvest. As you build your legacy and aspirations, we will be by your side to help you secure the future for you and your loved ones. Start taking control of your
Assalamualaikum and very good evening, everyone. Thank you for joining us today. So in fact, this is our second webinar for this year. So my name is Nazri and I am your moderator for tonight. So today's market update is about the investment themes and opportunities for year 2022 by our expert presenter, Ms. Serin Chen. She is our Senior Portfolio Manager in Principal Asset Management Singapore. And I believe that this topic is still relevant as we yet to complete and our first quarter of 2022. All right, a bit of our speaker background. Ms. Chen holds a degree in Bachelor of Business Administration with the first class honor, guys, from the National University of Singapore. And she is a CFA holder as well. She has over 21 years of working experience in the financial industry. She has been with Principal more than 7 years. And prior to that, she has worked for other reputable companies as well. So her expertise is in managing Asia-Pac equities funds. In fact, she is the co-manager for our two flagship funds, namely Principal Asia Pacific Dynamic Income Fund and Principal Islamic Asia Pacific Dynamic Equity Funds. So before we start, a reminder, should you have any question during the presentation, feel free to type it in the chat box. Our presenter will respond it after later. So due to time constraint, the question with the most like will be answered first. So hence, click like for question that you think is beneficial for you. So without further ado, I pass the floor to Serin. Over to you, Serin. Thank you.
Thank you, Nazri. Let me share my screen right now. Right, I hope you can see them. Good evening, everyone. Thank you for making time to attend this webinar. Today, I will start very briefly on the market overview and the market outlook for 2022, and then move on to share the investment themes and opportunities for this year and for the long term, followed by portfolio strategy for both Principal Asia Pacific Dynamic Income Fund, or APDI for short, and Principal Islamic Asia Pacific Dynamic Equity Fund, or IAPDE for short. So let's look at what has happened so far. For 2021, Asia Pacific ex-Japan markets declined by almost 5%, mainly due to the poor performance of China. China was the worst performing market in Asia last year, which was affected by the regulatory clampdown, the pivot to common prosperity, and a slowing economy made worse by the energy crunch in the fourth quarter of last year. So other factors include the strong inflation print that fueled rising inflation expectation and rising interest rates. So year to date, in 2022, the market declined by more than 10%. This is led by the sell-off in the growth names like technology, as the monetary conditions are expected to tighten faster than expected. Moreover, the rising commodity prices are adding to the fears of earnings downgrade and inflation staying higher for longer. So as a result, what we're seeing so far is that energy and material sectors have continued to perform better. So going forward, we think that the key issues is about how long the Russia and Ukraine conflict will last, the impact on inflation and global economy, and the direction of policies in China. The consequences of the geopolitical risk was rising commodity prices, and that fueled inflation and potentially negatively impacting consumer demand. Persistently high oil prices means that inflation in the United States stays elevated for longer. Now, typically, US Fed does not react to supply side inflation risk, but because of the strength of the US labor market and inflation already at high levels, there are some concerns that the policy is tightened too aggressively when growth momentum could be slowing. Now, the Fed hiked 25 basis points as expected 2 days ago, but the dot plot has shown a median of 7 hikes in total this year. Markets has previously priced in 6 hikes in 2022. So we see the inflation is really a concern, and as well as the tightening of monetary condition. Now, our view is that inflation may moderate in 2022 as supply chain disruptions gets resolved right closer to the end of the year and geopolitical tensions abate. Labor participation increases and pandemic-related financial or fiscal stimulus effects wear off, and that will actually lead to a moderating inflation. With regards to Russia-Ukraine conflict, as we know, the negotiations are underway. There may be, some light in the tunnel. Now, it's difficult to predict exactly how this will play out. However, if we were to look at past geopolitical shocks, right, and the impact on the equity markets, that can give us some sense of how the market may respond. So from history, geopolitical events are often short-lived and rarely have a significant impact on equities, sustained impact. Now, steady positive economic growth, corporate performance, monetary policy, and valuation actually matter much more than the short-term market uncertainty. So in the long run, it is the underlying economic backdrop that will dominate market trends. Although a sustained rise in oil price could weigh on economic growth, the impact could be tempered by continued consumer resilience, healthy household and corporate balance sheets. At the same time, central banks are unlikely to shift their focus on tightening in response to this geopolitical conflict. Thus, while in the near term, markets may remain volatile, the constructive macro backdrop should in time stabilize conditions. And we will talk about this a little bit more later. Lastly, on China, we continue to expect the government to roll out targeted measures to support growth. Economic momentum in China has remained sluggish in the first 2 months of this year due to moderating service sectors as a result of the rising COVID cases they had and the zero COVID policy. If we were to look at the monetary policy stance for China, though, unlike the rest of the world, China has an easing monetary policy. China has announced a GDP growth of around 5.5% this year. And this is a good guidepost on what China is thinking about in terms of growth and what the likely policies would be. On the earnings front, Asia should print stronger growth in 2022, given the reopening of the economies and international borders. However, we are aware about the rising energy and commodity prices and the impact on economic recovery, and that could be a drag on earnings. Given the uncertainties, the heightened volatility and risk, what we are doing in terms of our portfolio construction is that we are diversifying the concentration of factors. We are reducing risk where appropriate. We will continue to focus on quality companies with growth and reasonable valuation. So for the portfolios we manage, we have broadened out our exposure such that we are not overly concentrated on any areas of factors to navigate these volatile markets. So by quality, we mean companies that have high return on equity, They have a strong franchise. They have shown resilience in volatile markets, and those, especially in this environment, having pricing power. So if there's any situation where these quality companies' share price corrected to unjustified levels, these are opportunities to invest for the longer term view. Other risks that we have not spoken about would be policy mistake, where the central bank probably tightened too aggressively relative to the health of the economy, and the renewed US-China tension, which we have seen some in some form in terms of the potential delisting of the Chinese companies in the US. Now let us go through some of the slides to discuss what I have summarized. This slide shows that the developed world continue to show very strong activity with manufacturing PMI above 50. And even for Asia as well, except for Hong Kong due to the strict safe distancing measures to cope with COVID. Now, manufacturing conditions in ASEAN has also improved strongly in February. Input costs increased, but the firms are actually raising prices to reflect the rising input costs. Now, before the geopolitical situation, we believe that the global economy will continue to recover into 2022 as supply chain issues eases and the increase in vaccination rates may mean that spending on services can start to increase more meaningfully. And in particular, we think that this growth leadership will actually shift to Asia in 2022 as the Asian economies move to fully reopen their economies when they reach herd immunity. So when the Russia-Ukraine conflict eases, we think that this will still hold true, that Asia has a stronger growth potential, maybe relative to, like, say, Europe, where there could be some growth challenges with higher inflation. Now, the teething issue right now is the high energy cost that's feeding into inflation, as you can see in this chart, where energy prices have risen sharply. And in this slide 11, it is a chart on global inflation, which has been rising since 2021. So indeed, the inflation outlook is getting difficult. I think the market will look through this inflation that is caused by a spike in oil prices, and more importantly, focus on the underlying inflation, and specifically the demand-led inflation. So we will be looking out, for signs where inflation expectation is peaking. So probably if the month-on-month inflation number is not looking incrementally worse, then that could be a sign, and that may provide some reprieve for risk assets. So as I mentioned earlier, our view is that inflation may moderate into the late 2022 as less stimulative fiscal and monetary policy feeds through, supply chain improve, labor participation increases, and geopolitical tension eases. Now to China. China manufacturing PMI recovered to above 50 in February as new orders grew the most. Now, furthermore, we are seeing some infrastructure activities being accelerated. China manufacturing PMI is a good sign, but if we were to look at the consumption indicators, you can see that they are actually quite weak and deteriorating. The Chinese government has shifted its focus to stabilize the economic growth and announced a GDP growth target of around 5.5% earlier this month. Macro policy has become more growth supportive. We think that this will be more targeted. And what our expectation is that there will be further cuts in terms of the loan prime rates as well as the RRR. And in fact, there's some rumors today that China may be looking to cut RRR maybe this weekend. So to boost consumption, we think that there has to be some changes in terms of their approach to managing COVID. So President Xi today has, while reiterating his commitment to the zero COVID policy, said that China will strive to achieve maximum protection and control and minimize the impact of this pandemic on the economic and social development. So this may signal some shift. Otherwise, in investment, infrastructure spending in areas like environment, water, green energy, etc., is likely. On the earnings front, Asia Pacific ex-Japan is expected to post 9.1% earnings growth in 2022. And Taiwan and Korea are seeing the highest EPS revision. Sectors that see the most upgrades are, of course, energy and materials, as well as industrials in Asia. Asia should print stronger earnings in 2022, as mentioned, due to the reopening of the economies and the borders. So over here, you can see the table that relative to the rest of the world, Asia ex-Japan earnings is expected to be higher than US and Europe. Again, here we need to be aware of the rising energy and commodity prices, and we'll watch, the growth closely, as we may expect some earnings downgrade. So in summary, due to the uncertainty arising from geopolitical events, the consequences of high inflation and low consumption, as well as the potential fiscal and monetary policy that may be rolled out in China, what we have done in terms of our portfolio positioning is to reduce risk and diversify across sectors. And for China, we have been focused on stock-specific ideas that could benefit from the regulatory tailwinds or sectors with drivers that are less dependent on macro. We also have a preference for longer-term structural themes and quality companies that will benefit from these trends. And right now, I would like to share with you some of these investment themes and opportunities. This is a summary of the investment opportunities arising from industry change, such as renewables, automation, electrification of vehicles, digital lifestyle, etc. Now, the first two themes are related to decarbonization. Decarbonization targets will continue to be of focus as many countries have pledged to be carbon neutral by 2050. And in order to reach the decarbonization targets, the adoption of electric vehicles and the buildup of renewables need to accelerate. Transport is one of the largest contributors to the global carbon emissions, and many countries have announced the phasing out of sales of internal combustion vehicles. This chart shows a sharp increase in penetration rate of EV globally going forward. By 2025, EVs will represent 13% of total sales from 4% currently. And for China, due to the government's push and target, China EV penetration is expected to reach 25% by 2025 and 43% by 2030. This rapid increase in adoption is actually in part driven by lower battery pack price, which is expected to fall more than 30% to below $100 per kilowatt hour by 2024. Beneficiaries of this trend would include upstream raw materials like copper, nickel, battery components like separators, battery makers, or even autonomous driving software, as many Chinese EV startups are trying to differentiate themselves through the launch of smart EVs. Now, the next theme is actually renewables. Many countries are increasingly turning to renewables as the source of energy to meet their decarbonization targets. So new projects are now very viable as the cost of solar and wind projects, for example, in China, are at grid parity. So you can see in this chart how much the cost of solar panel module have declined over the years to just the 38 cents per watt. Beneficiaries of this trend would include the component manufacturers, such as the solar panel module, the inverters, or the energy storage, in order to integrate the renewable energy into power system. And Asia is the best place to invest for this team. Asia Pacific is responsible for 49% of the global carbon emissions, and likewise will present numerous opportunities as Asia aims to reduce this carbon emission, as well as transiting into a more sustainable form of energy generation. Chinese companies produce 80% of the world's solar panel and 95% of the upstream material solar wafer. Some Chinese companies are also one of the largest wind turbine manufacturers in Asia. Even in Thailand, we have companies investing in solar and wind farms. Hence, there are many opportunities to benefit from this growth in renewables. COVID-19 has changed the way we live, we work, and play. From working from home to buying things from home to seeing doctors from home. The adoption of e-commerce accelerated, and this trend is not going away. We have seen many hospitals in China, India, Thailand, and even Australia starting to roll out telemedicine as a way to treat patients and extend their reach, as well as e-pharmacy platforms for their outpatients to purchase medicine or to buy, vitamins or supplements. Now we find that these online opportunities are adding value to the hospitals as they extend the reach beyond inpatient care, as well as more efficient hospital management by treating chronic patients online rather than on-site. In terms of finance services as well, we are seeing more internet banking or digital banking licenses being issued, such as in ASEAN, and the use of e-payments. So these opportunities are not confined to China, but there are also investment opportunities elsewhere, such as India. So in this slide, we actually compile some examples, and we see companies like Reliance Industry developing their own retail online platform and other digital offerings, as well as Tata Group trying to create a super app and investing in online grocer and e-pharmacies. Lastly, what the pandemic has made many companies realize is the need for localization and automation. So the last theme that I would like to discuss today is regarding manufacturing. Now, as we roll out 5G, we can expect an increase in terms of the adoption of smart delivery robots, like control and operate machineries remotely in factories, for example, manage better downtime in machines. Now, all of these are termed as industrial Internet of Things. And as a result of e-commerce, telemedicine, and deploying Internet of Things for monitoring purposes by governments and corporates, the demand for data center and data center compute will be strong. So Gartner is expecting, cloud services and end user spending to increase by 21.7% this year. This is positive for server, storage, networking, and by implication, memory, silicon wafer, etc. To upgrade the network infrastructure and end devices from 4G to 5G, many critical components are needed. And in this case, the semiconductor industry and its related supply chain are viewed as major beneficiaries. So that is why we like the memory sector. Now, I would like to talk about our two funds, our flagship conventional fund, which is the APDI, and our flagship Islamic fund, IAPDE. Now, for both of our funds, our strategy is similar in the sense of how we are navigating through this period by reducing risks and diversifying across various sectors. Let me start with APDI first. This slide shows the performance of the fund. For the year 2021, the fund value was almost unchanged in US dollar terms, and year to date, up to 28 February, the fund lost value of about 4.4% in ringgit terms and 5.1% in US dollars terms. I would like to point out that the longer term track record of the fund is that over the years, our average annualized return is almost 12% in US dollar terms since 2016 to 2020. Now, uncertainty has led to PE multiples compressing, and there's rising volatility. So we are mindful of the various risk scenarios that are developing, and we are focused on ensuring that our portfolio construct has a sensible risk profile. So as such, for APDI, we will continue to focus on quality companies which have good earnings visibility, robust balance sheet, long-term winners, market share gainers, and those with pricing power to overcome cost pressures. Now, if we were to look at the top 10, you can see that we continue to like quality growth companies with reasonable valuations, such as TSMC and Samsung Electronics. As I mentioned earlier, we like the memory space. We also have positions who are beneficiaries of the energy, such as CNOOC. We like quality franchises, such as AIA, and selective China internet platforms, where we think that the regulatory uncertainty has likely peaked, such as Tencent and Alibaba. One of the themes I mentioned earlier was about electrification of vehicles. So we have that LG Chem as the beneficiary of the adoption of EVs. Companies who are long-term winners, such as Reliance and Tektronix, are also our focus. The portfolio is also positioned to benefit from rising interest rate cycle in terms of our exposures to financials. So you can see over here, we have DBS Group, but outside of this top 10, we also have other financials. Now we remain highly invested with cash level at 6.33%. Cash is a residual of our stock selection process. APDI is a high conviction portfolio with 52 stocks. So if I were to show you on the next slide to give you a flavor of what changes we have made since the beginning of this year, we have reduced our exposure to information technology, which has done well, and so we took profit and also with a view to reduce risk. We have already built up our positions in financials towards the end of last year, so you can see over here that there is minimal changes in terms of our financial position. As mentioned, we diversify our exposure. So over here, you can see that we increase the exposure to healthcare and energy in the last 2 months. Slide 32 here will show you the country allocation changes. So we have increased our allocation to Singapore, to Indonesia, China, Hong Kong, and at the expense of taking profit on India and selling up our technology exposure in Netherlands and communication services in the US. Now the exposure in Netherlands and US are names where they have exposure to Asia Pacific ex-Japan and is allowed under the mandate. And within China portfolio, what we have done is that we have reduced position where we felt the risk was higher due to potential margin pressure as a result of rising raw material costs and demand side weakness. Tactically, what we have done is also by moving our portfolio structure towards a bit more defensive positions, such as telecom. But we are not buying telecom companies just because it's defensive. The companies that we bought generally also have a positive fundamental change in terms of competitive environment or pricing, etc. So the next slide shows you a snapshot of our country and sector allocation for APDI. So I'll just pause there for a while. I can come back to this slide later if you have questions. Let us move now to IAPDE. Now this is the Islamic flagship fund, and slide 35 shows the performance of the fund. Year to date in February, the fund value declined by about 6.5% in ringgit terms. Now, this is a relative fund as opposed to APDI, which is a total return or absolute return fund. So if we were to compare IAPDE with the benchmark, we actually underperformed by about 2.5% year to date. However, if we were to look at the longer term performance of the fund for the 3-year and 5-year track record, this fund has outperformed the benchmark significantly. In 2021, we outperformed the benchmark by close to 400 basis points. And in 2020 by more than 10%. So for this fund, we remained fully invested. We favor quality and liquid names with good earnings growth and visibility. As with APDI, for IAPDE, we also diversify our holdings across countries, businesses, and factors to improve the portfolio's resilience. So some examples of our recent purchases were in the areas of healthcare, new energy vehicle supply chain, communication services, and energy. And we have funded this by trimming some selected stocks where growth durability is lacking and where valuations are lofty. And some of these are can be found in, say, India. And technically, we have also introduced some defensive themes into this portfolio, such as healthcare, telecom, and also some Hong Kong REIT. Although IAPDE is a relative fund, we are benchmark aware, but not benchmark constrained. So this fund is able to invest in some off-benchmark names that are approved by the Shara advisor. And these holdings is about 40% of our fund. So we currently hold 7.6% in cash. Again, cash is a residual of our stock selection process. Our top 10 in this fund again illustrate our preference for the memory sector, like Hynix, Samsung E, and TSMC. The rollout of 5G, for example, MediaTek, as well as long-term winners like Reliance. We are also invested in energy for Santos and selective China internet platforms such as Tencent and Alibaba, because we have a view that the regulatory uncertainty have peaked. Slide 38 gives us a snapshot of the country and sector allocation for APDI. The information technology sector may look large over here, 37.45%, but we're actually underweight technology if you were to compare it with the benchmark weight, that is more than 50% of the benchmark. So I have come to the end of my presentation, and I'm ready to take any of the questions. Thank you.
All right, thank you, Serene. Before we proceed to Q&A, I'll share some of the good news tonight for all our attendees today. Right. So first announcement, we actually just enhanced our principal online portal. It has been upgraded whereby you can now invest using your cash investment. All the while you're using your ETF Invest, but moving forward, you can invest using your cash investment as low as 500 ringgit. So indirectly, you can transact anytime and anywhere. You can also view all your unit trust holdings in a single view. In fact, we have more than 50 funds to be selected, comprises of different asset classes. We have equity, regional and local. We have balanced funds, we have fixed income, or even money market fund. So good news, from now until end of this month, all your service charge will be waived. So you're investing at 0% sales charge. So it's not that. We have second good news tonight. For those that attending tonight webinar session, exclusive for the first 20 investor only, from now until tomorrow, we are giving you one-time 50 ringgit Touch and Go e-wallet reload pin for any investment, minimum 500 ringgit for cash or 1,000 ringgit in iInvest. This is applicable either you are new to Principal Online or even you are actually our existing online investors. So please make sure you use the campaign code Principal Webinar 2022. I repeat, Principal Webinar 2022 when you submit your submission. So offer valid from now until tomorrow. It's limited for the top 20. So grab this opportunity. So I guess this is the end of the sharing of the promotion. So let's go to the Q&A session. All right, there's a couple of questions posted here. So the first question here, Serene, what is your view in ASEAN equities, especially for Indonesia?
Yes, thank you for the question. I think within ASEAN, other than Singapore, I think Indonesia is probably one of our preferred country for exposure. I think in this time where there's rising commodity prices, in Indonesia being one of the commodity exporters, they are set to benefit from these rising commodity prices. But in general, for ASEAN, we are actually quite selective in terms of what we like, because the markets are not as deep as elsewhere. So within the portfolio, we have while we have kind of increased our ASEAN exposure, but we have been very selective in our exposure to benefit from some factors like maybe banking, because think that if the economy is improving, then the asset quality will improve, and provisions and as well as the interest rate cycle will benefit the banks. So we have been quite selective, but in general, yes, we do like Indonesia. Thank you.
All right, thanks, Serene. So basically, you already answered the second question. So then, yeah, it's about the outlook of the banking sectors. All right, so the third question here. So I guess this is pertaining the EV automobile. So these disruptive sectors, though we understand, it is definitely the long-term growth prospect. But does it mean that KT's Wood ARKK is currently a good buy, as well as Tesla, for good opportunities? This is a very specific stock. So I guess maybe you should elaborate on the fund level in terms of.
Yeah, sure. Well, I think in the short term, there's a bit of concern on the outlook for EVs because of the shortage on the chips, and as well as the rising commodity prices. So because of the rising nickel price as well as the lithium prices, the battery prices have actually increased quite significantly. And what the OEMs are trying to do is to raise price to offset the rising costs. So that may actually negatively impact some weakness in demand, say in China, because the economy is slowing, and that could have some impact in terms of consumer sentiment as well because of COVID. So I think in the short term, there is this risk that the volumes for the electric vehicles may disappoint. However, I think in the longer term, our preference is actually on the component makers and the upstream rather than downstream or the OEMs, because we think that the competition is actually kind of heating up with the OEMs launching many EV models. And so because of this rapid adoption of electric vehicles, I think the main beneficiary would be the component side, where there are also in some areas there are some supply tightness due to lack of equipment, etc. And so therefore we find that the most in terms of risk reward is most favorable in the components supply chain. I hope that answers your question. Thank you.
All right, thanks, Serene. So next question. Okay, some say the commodity prices will remain elevated for some time. What is your view if the price level continue to stay high in 2023? And each sector benefit currently in your existing portfolio, perhaps? Yeah.
Right. So I think yes. I guess there is a risk that the inflation may stay higher for longer. So I think in terms of our portfolio, what we have done is we have actually focused on looking for companies that have pricing power. So I think that is most important, because if the company is able to pass on the cost to the customers, then the margins can at least remain intact. That's one. And second thing that I think what we are looking at also inflation beneficiaries. So we do have some positions who will benefit from high inflation because maybe their products are linked to inflation, for example. And there's higher commodity prices, then I think energy would be one of the the commodity that will stay high, and so we do have exposure there as well. So what we will be avoiding are those where higher prices may lead to some demand destruction, or where the products are commoditized, such that they cannot pass on the costs, and therefore they will suffer from margin compression. So in terms of the portfolio, that's how we have positioned. And lastly, if the inflation stay higher, so that would mean that interest rates will probably have to interest rate hikes will continue, and that would also mean that the banks, financials, will also be beneficiary as with the rising interest rate due to the expansion of them. Yeah.
All right, thanks, Ray. So next question, this is about China. Okay, interesting. When asked what is the biggest risk to China recently, quoted in a CNBC interview with Jeremy Grandam, he highlighted that the biggest risk in China's overall debt. What are your views on this?
Is on debt.
Yeah.
Well, I think yes, I think that especially what we're seeing about the property, the loan, the debt, and the offshore and onshore, some of the defaults that we have seen. But I think so far the government has been containing this contagion risk, and I think, in my opinion, for equity markets, probably the biggest risk, in my opinion, is probably the regulatory risk, continued regulatory risk, and with the internet names, and as well as the rising US-China tension, because then that will have implication not just for risk assets but also the economy, just as what we're seeing during the trade war, and the impact on the equity markets has been negative. Yeah, that's my humble opinion.
All right, thanks, Ray. So we still have 3 minutes. I guess we can ask a few questions more. So this is interrelated to the funds, okay, for the APDI and Islamic Asia Pacific Dynamic Equity. So the question is, how does these two funds complement each other if we invested in these two funds together? So would there be an overlapping in exposure or low correlation among them? I think you already answered. Maybe you just articulate more about this.
Sure. Well, I guess one difference between Islamic and the conventional is that the Islamic does not have financials, because it has to be Sharia compliant. So that's one. So if you buy both, then you have the financial exposure from APDI. And I think the other main difference is probably in terms of the exposure to information technology. So it's quite high for IAPDE. However, I think if you were to look specifically more to the construct of the portfolio, in terms of the overlap in the number of names, there's actually quite a number of names that overlap. The difference is just the different exposure or weighting, because APDI can invest in financials, but IAPDE can't. So there would be some redistribution of that financial weight to something else. Yeah, I would say that in terms of the names, there would be overlap. It's just a matter of exposure. Yeah, I hope that answers the question.
All right, thanks. So next question, maybe the second last question. As the sanction of Russia intensified, that could lead to higher inflation, would that change your view on the easing inflation towards second half of 2022?
Yes, I think that if the commodity price were to continue to stay high, that might have a negative. That is the risk, right, to our view that inflation may moderate in 2022. But I think because currently the inflation has been a factor of supply chain issues or disruption, and I think some part is also because we haven't been able to travel. We can't travel in some labor migration that would that may help to ease some of the wage pressure. So once more and more people are able to move around, and companies are able to find labor, not just domestically but also internationally, then the wage pressure may come off, may ease, right? So I think that is one of the reasons why we think that inflation will moderate end of this. So yes.
All right. So last question for tonight. Yeah. So this is interesting question to close our Q&A session. So my investment is heavily on China and US region. So what should I do, or what can I do to balance out my portfolio?
Well, I think you can look at Asia because I think as what I presented earlier, we think that Asia economic growth and earnings growth starting from this year will be relatively stronger than US and Europe in general. And so that will actually provide support, right, for the equity markets. And secondly, China is in a different, I would say, monetary policy cycle than the rest of the world, right? It's easing, and if the government is successful in boosting the economic growth, right, and having the 5.5%, that will also be, spillover effects for Asia as well, right? Because if say they're going to spend a lot of infrastructure, then they will need the iron ore, they will need the nickel, or they will need the copper, and all these, the neighboring countries like maybe Australia and Indonesia will be beneficiary of those. So I think, and so that's why I would say that, especially in times of uncertainty and volatility, it will be good to have a diversified, a portfolio, and so Asia start to do well. Thank you.
All right, thank you very much. So we are coming to the end of the session. So for those that attending the session, I would like to say thank you very much. And we do hope that we'll see you again during our next session. And Serene, thanks a lot for your sharing tonight. So with that, stay safe and we'll see you again in the next session. Bye-bye, guys.
Thank you. Bye-bye.